Alright, so let's get straight to the point. The Iran-US situation is still the main driver. And today the market is treating it as a live risk event, not a solved story. The most important thing you need to say clearly is this. The ceasefire may exist in official language, but according to President Trump, it is on life support. That's the phrase he used after rejecting Yearn's response to the US peace proposal. In market terms, that single sentence is enough to keep the risk premium alive. Because traders hear that and assume the path to stability is longer and more fragile than people expected. It's about uncertainty. It's about the unknown variables that are now back on the table. Welcome back to Yearn to Grow. This channel is about understanding finance and insurance clearly and calmly. No pressure, no shortcuts, just clarity. Now here's what happened after Monday. Clean and simple. Let's break down the actual timeline of events that moved the needle. Iran sent its response to a US proposal through Pakistan. This diplomatic channel has been critical. The Pakistani officials acted as the intermediary for this high-stakes exchange. That response, based on what was reported, was framed around ending the war and restoring maritime security. It was presented as a plea for stability in a region that has seen none. Basically, it was an offer to stop the fighting and make the strait safe while leaving the bigger issues for later. It was a tactical move designed to de-escalate the immediate physical threat to trade. But then Trump dismissed Iran's response publicly, calling it unacceptable. This public rejection changed everything. And that is what pushed the entire narrative back from deal momentum to deal uncertainty. The market sentiment shifted overnight as the hope for a quick resolution evaporated. And while all this is happening, the Strait of Hormuz remains the center of gravity. It is the heart of the global energy supply. Without this passage, the world's energy pulse begins to falter and skip. The latest reporting describes oil staying elevated because Iran has effectively tightened or near-closed the passage. And global shipping is still seeking safe passage. It's not just about one single attack, it's about the persistent fear. Every vessel in the region is on high alert, navigating with extreme caution. It's the constant uncertainty around the world's most important energy choke point. This is where the world's economy is held in a delicate and dangerous balance. This week also added an important international angle. The United States and China have publicly aligned on one point, that no country should impose tolls on shipping through Hormuz. This rare alignment is a major development. It signals a shared priority for global trade stability above geopolitical rivalry. That matters because Iran has demanded tolls as a condition, and now you have the US and China taking a common position. This joint stance creates a significant diplomatic barrier to Iran's current strategy. This increases diplomatic pressure, but also shows the dispute is still unresolved. The stalemate continues despite the joint statement. At the same time, Trump is now traveling to China for a summit with Xi. This meeting is the focal point for every global trader. The eyes of the world are fixed on Beijing as these two leaders prepare to talk. And Reuters reporting makes it clear that the Iran war and Hormuz situation are going to dominate the conversation. A high-quality image of a red, live news indicator. This isn't just a side topic, it is the primary agenda item for the summit. Markets are watching that summit like a trigger event. One single statement can hit oil, gold, equities, and currencies instantly. The potential for sudden, violent market swings is at an all-time high this week. It's a high-stakes game of diplomatic chicken. Every word uttered in Beijing will ripple through the trading floors. A single sentence could either calm the markets or ignite a massive sell-off. So that's the Iran-US situation in one sentence. Diplomacy is active, but Trump's rejection means risk is still very much alive. We are in a state of suspended animation, waiting for the next major move. Now I'm going to shift into markets. First oil, then gold. And I'll give you today's bias. Whether buy side or sell side is more favorable. Oil, what it's doing today and why. We need to understand the structural forces at play here beyond the headlines. Oil is still trading in the low 100s and staying supported. It's showing remarkable resilience despite the volatility. Today's Reuters snapshot had Brent around 107.5 per barrel and WTI around 101.75, with prices easing slightly after a multi-day rally. Even with that small dip, oil is still holding above the crucial 100 area. It's a defensive posture by the market, refusing to let go of the premium. which tells you the market is not comfortable removing the war premium. The risk is still being priced into every single gallon. Now, the reason oil is sticky is not just politics. The International Energy Agency has also provided some sobering data. They've said global supply is expected to fall below demand this year because of the Iran war disruption and other output declines, which keeps the market structurally tight. That means even on quiet days, oil doesn't fall easily. The floor is very solid. This structural deficit provides a fundamental backstop to any geopolitical cooling. Oil bias for today. For today's trading bias, the more favorable side is buy the dip. It's the strategy that aligns with the current macro. We are looking for opportunities to enter on weakness rather than chasing the strength, but only while price holds the key support zones I'm about to give you. This is not a blind buy. I cannot stress that enough. Precision is everything in a market this volatile. Know your exit before you enter. It's a conditional bias based on the fact that the market is still pricing Hormuz risk and supply tightness. Always trade the reality. Think of Brent with clear battle zones. First support is the mid-106s. If buyers quickly step in here, it confirms our buy the dip bias. This is the primary area to watch for buyer re-entry. It defines the immediate short-term support for Brent oil. The second stronger floor is between 105 and 104. If this region fails to hold, the war premium is draining from the market. The ultimate line in the sand is 100. Below that, the trend flips completely. Resistance sits at high 108s, where rallies stall without headlines. The low 110s are the major hurdle. Breaking and holding this requires a fresh trigger, like a confirmed shipping incident or talks collapsing. Oil spikes if there is any confirmed escalation around shipping or restricted passages. Physical flow risk is key. What would drop oil today? Oil drops sharply only if we get a credible diplomatic surprise. Something concrete, not just a rumor. Something like revised terms accepted or a clear pathway to reopen Hormuz. Markets need visible normalization, not just talk. Now let's talk about gold. It's a different story today, and the reasons why are fascinating for any macro trader. Gold, what it's doing today and why. It's not behaving like a pure safe haven trade right now, and that's the key takeaway. Reuters reported spot gold around $4,695 per ounce, easing after hot US inflation data. The key point is that oil has driven inflation higher, and that reduces the probability of quick rate cuts. The macro is working against gold. When yields and the dollar strengthen, gold gets capped even if geopolitics are tense. The safe haven appeal is being countered. So gold right now is pulled by two forces. War risk supports it, but higher for longer rates cap it. It's a classic macro conflict. That's why you can see oil strong while gold is soft. The correlation we expect isn't always the one we get in this environment. Gold bias for today. For today's bias, the more favorable side is sell the rally unless gold reclaims its key pivot zone. This is a macro-driven day for gold. Inflation and rate expectations are dominating the narrative. Don't fight the Fed. Always watch the data. Gold's levels are equally clear. Support begins at the high 4,600s where buyers are still defending despite the macro pressure. Gold's levels are equally clear. Support begins at the high 4,600s where buyers are still defending despite the macro pressure. Below that, the mid-range and the psychological 4,500 zone are key if the dollar stays firm and yields remain supported. Resistance pivots at the 4,700s. Gold needs to reclaim this to shift our bias from sell the rally back to buy the dip. The upper 4,700s remain heavy. Breaking through requires a major shock escalation or a clear drop in yields. Watch the headlines. What would make gold rally today? Gold rallies if you get a true shock escalation that overwhelms the rate effect. Unexpected. What keeps gold heavy today? Gold stays heavy if inflation expectations stay hot and the market keeps pushing rate cuts out. That keeps the dollar supported, which pressures gold. It's a weight that the gold market is struggling to lift. The dollar is king today. Now, let's bring this back to India. Because right now, India is reacting strongly. The ripple effects are very visible. Stunning wide shot of the gateway of India in Mumbai at dawn, iconic. The macro pressure is still visible through the rupee and oil sensitivity. India is one of the world's largest oil importers. It's a vulnerability. Reuters reported Indian equities snapped a 4-session losing streak with the Nifty and Sensex slightly higher. A much-needed relief move. But the reason the rebound happened is important. Gold and silver ETFs surged after India raised import tariffs significantly, from 6% to 15% to curb foreign exchange pressure. This is a bold defensive move by the Indian government. At the same time, Reuters noted the rupee fell to an all-time low. This currency weakness is a direct result of the oil price spike. The everyday citizen is beginning to feel the heat as import costs translate into higher prices at the pump and beyond. The reporting connects that weakness to elevated oil prices and continued outflows. Capital is leaving for safer, higher-yielding havens. So the market bounce is not, everything is fine. It's a local relief move inside a stressed macro backdrop. Context is everything. So if you want one clean line for India impact, it's this. As long as oil stays high, India's inflation and currency pressure remains, which keeps equities sensitive and forces policy actions like higher import duties to protect foreign exchange reserves. It's a fight for stability. Now here's what we can expect next. This is your roadmap for the coming week. First, the Trump-Xi summit headlines. This is the biggest event on the calendar. The whole world is listening for any sign of a breakthrough. Markets will watch for any sign of China pressuring Iran diplomatically or any agreement around Hormuz access. Watch closely. Second, any Hormuz shipping development. This is where the physical reality of the war meets the global economy. Watch the water. It's the front line. That includes toll demands, blockade decisions, and shipping incidents. Anything that changes the probability of physical flow disruption. Reality matters. Third, macro inflation follow-through in the US. This is the structural force that is capping gold and driving the dollar. The data is our guide. Hot inflation data was already reported as the highest annual rise in 3 years. If that continues, it supports yields and caps gold. Watch the trend. Fourth, India's rupee and flow picture. This is the local story that matters for millions of investors. It's about the domestic health of the economy. With foreign outflows and oil high, the rupee remains key for Indian equities, and policy measures like duty hikes can increase. The RBI will be busy. So to wrap it up cleanly, the Iran-US situation remains the main driver. Diplomacy is active, but the ceasefire is on life support. Risk is the word. Trump rejected Iran's response, which keeps risk premium alive. Oil is still supported in the low 100s because the risk is very real. Gold is softer because hot inflation and higher for longer rates are capping it. India is feeling this through rupee stress and policy action. It's tough. The directional bias favors oil on the dip and gold on the rally unless key levels reclaim. Success requires discipline and constant vigilance in this environment. Keep your eye on the levels and stay informed as the situation evolves hour by hour. This is the roadmap for navigating the current market storm effectively and safely. If this explanation helped you see things a little more clearly, that is exactly what this channel is meant for. If you find this helpful, please like the video, subscribe to the channel, turn on notifications so you do not miss future videos.